Results season continues apace for the European banks, and SocGen's Q4 numbers show the French bank is short of options. That's according to Reuters Breakingviews. Joining me is George Hay. Good to have you in the studio, George. 2013 will bring more visibility, said the CEO. The shares are down. The market doesn't buy it?
Well, SocGen's got a few advantages at the moment in the regulation, things like the Likkanen ring fencing and liquidity reforms. They've all kind of turned out quite good for SocGen, but they've got their main problem is that they're not making much money. Their returns are very low. They're only about 7% return on equity, and that's way below the kind of benchmark that investors would expect, which is more like kind of 11 or 12%. And that's a big problem.
But the restructuring they're talking about, does the market believe this is going to sort this problem out? Well,
the trouble with their restructuring is that even if it goes well, they still only think it will get them to around 10%, which is still below this all-important so-called cost of equity, which is at 11 or 12%. And that's the point at which investors start to get happy about owning any stock. And that's the main problem for SocGen. They need to get to that level in order to cheer up their investors.
What do you make of the reshuffle and Badre leaving to go to the World Bank after just 1 year? I mean, what's the real story there, do you think?
Well, I think probably the real story is actually what I said, the fact that if you're running SocGen at the moment, there are a number of levers you can pull, but not many of them can actually get you to where you want to be, which is beating your cost of equity. And it might just be because Mr. Badger wants to go to the World Bank. But frankly, if I was running that bank, it would be a bit of a headache. All these things are difficult to deal with.
I just want to throw in ING. I know this, you're writing about SocGen here, but ING was out this morning as well. That was disappointing as well. I spoke to the CFO, who seemed, because they're cutting costs, another 2,500 jobs or thereabouts after some layoffs in November. Trying to get out of the CFO what's actually changed between then and now. And he and maybe this is wrong for me to say, was fobbing us off with this idea of they're moving aggressively online and you need less people there. But my response is they've been heavily into online for a long time. What's the story there?
Well, that's what you say is true. They are in online, but I suppose maybe what's changed, or one of the key things that's changed since November, is that one of the key banks in Holland has collapsed and been nationalised. And there is an element in what they're saying today that ING is going to need to reach into its pockets to help cover the costs of that, as other banks in Holland do. So that won't be helping. But I think the kind of fundamental problem that ING, and you see it elsewhere with Commerzbank and a number of other European banks, they are not making much in the way of revenue growth at the moment. They haven't been in the last couple of years. So the only way you make your return targets is to cut costs. And it's really as simple as that. There are, I think, specific problems in the Holland market, particularly to do with real estate, and that's why SNS collapsed. But basically it does come down to the fact that they need to cut costs, or there's not much else they can do.
All right, George, thank you very much indeed. George Hay from Breakingviews. If you want to watch our US show, that comes on every day, 12:30 Eastern, 17:30 GMT. I'm Axel Threlfall. This is Reuters.